Right before silver contracts could be converted into real metal, the exchange suddenly goes offline. Technical issue? Maybe. Convenient timing? Absolutely. Here's what happened. Just before First Notice Day, the moment when paper silver contracts can stand for physical delivery, the CME, which runs the COMEX, reported an outage. That's the same system where most gold and silver trading happens. Mostly paper contracts, not actual metal changing hands. Now normally, traders roll their contracts before delivery. They don't want truckloads of silver showing up at the door. But in 2026, something's different. Physical demand has been rising and more contracts are standing for delivery. That's where pressure builds. Because paper supply is massive, but registered physical ounces, not unlimited. For years, price control was simple. Increase paper supply, suppress price, calm the market. But when physical demand keeps climbing, that gap between paper and real metal becomes harder to ignore. Am I saying COMEX collapses tomorrow? No. These exchanges have deep pockets and plenty of mechanisms. But repeated coincidental outages right before delivery windows, that's why people start asking questions. And zoom out. This isn't just a US story anymore. Asia has been steadily building its own pricing power. China expanding physical settlement systems. India recently shifting mutual fund gold and silver valuations toward domestic spot pricing instead of relying purely on Western benchmarks. That's not noise. That's positioning. When the East strengthens physical price discovery and the West dominates paper pricing, eventually those two worlds collide. Prices can't diverge forever. It's financial tug of war, and the rope isn't infinite. Here's what really matters for you. Institutions aren't stacking paper promises right now. Central banks have been accumulating physical gold at record levels. That's public data. They're not preparing for stability. They're preparing for transition. So whether this outage was innocent or strategic almost becomes secondary. The bigger signal is this. Physical metal is gaining importance in a system built on derivatives. And if we move into a tighter delivery environment in 2026, volatility won't disappear. It will likely intensify. That's why smart investors don't panic. And they don't rely purely on paper exposure either. They understand the difference between futures contracts and allocated physical metal. If you're watching gold and silver right now, ask yourself one simple question. Do you own a price chart, or do you own the asset? Let me know in the comments. Was this just a glitch or something bigger? And if you want clear breakdowns without hype, subscribe. Because in 2026, understanding market structure might matter more than guessing the next price target.